If you think it's too late for 2025 to find and invest in a short-term rental and use the short-term rental tax loophole to offset your active income taxes, it's not. It's totally doable, and in this video, I'm going to walk you through exactly what this could look like for you and use an actual deal and walk you through actual numbers to show you just how substantial this tax write-off is using this incredible strategy. So I just want to say up front, I am not a CPA, and this is not specific tax advice for your situation. You should always talk to a CPA before you make decisions, but I'm speaking from the point of view of someone who has invested in real estate for the last 19 years and has benefited over and over again from this strategy that I'm going to share with you. And if you'd like to work together with me personally through the steps of finding, buying, and setting up a really great short-term rental, so that you can take advantage of this strategy that I'm going to share with you, you can book a call with me at the link in the description below, and you can share your goals on that call. And we can talk through the details of the Blueprint program that I teach and see if it's a good fit for your situation. So as I said, I'm going to walk you through a specific example deal, like with real numbers, and show you exactly how much you could save on your taxes if you just did a deal similar to this. But for those who aren't familiar with what the short-term rental loophole is, there's really three main aspects that you really need to understand in order to capitalize on this strategy. So this short-term rental tax loophole or strategy has been around for quite some time, but it just became much more powerful because of this so-called One Big Beautiful Bill that just passed, allowing you to now take 100% bonus depreciation in year one. So what this means is that the IRS says that the components of a business equipment or real estate that are deemed to wear out in under 20 years can be written off completely in year one. That's 100% in year one. So the IRS has shared specifically what components of a property they deem to wear out in what timeline. So it doesn't really matter how fast these components wear out. They've just assigned certain components to certain time frames. Typically, there's a 5-year time frame, a 15-year time frame, and then a much longer time frame. So if you think about a house, for example, the foundation probably isn't going to wear out in 5 or 15 years, right? That's going to be assigned to the really long time frame that we're not really concerned with for bonus depreciation. But things like appliances or flooring or decks or, things that will probably need to be replaced in a much shorter time frame than some of the structural components of the property, these all fit in this 5 or 15-year time frame, which is lower than the 20-year threshold. What you need to do is a cost segregation study. It's a very simple study that an engineer comes in, looks at all the components of the property, and they say, all right, this 25 to 30% of the property will wear out before that 20-year threshold, so we can 100% bonus depreciate that percentage, which is a huge chunk of the value of the overall property, and you can write that off in year one against your active taxes. So that's the first thing to understand. And then the second big component to this is that the IRS says that the property must be used as a short-term rental. And the IRS's definition of a short-term rental is that the average stay duration throughout the year where you're claiming this tax benefit must be 7 days or less. So that's a pretty easy bar to hit for most short-term rentals. So that's the second aspect. And the third and final component to making this all work is that the IRS says that you need to, quote, materially participate in the operations of your short-term rental. So this just means that you need to spend at least 100 hours throughout the entire year working on your short-term rental business, and that the hours that you spend can't be exceeded by any one other person. So as you can imagine, if you just go and outsource a short-term rental property manager and they handle all of the day-to-day and basically you're outsourcing everything, you're not probably going to meet the 100 hours, and you're also not going to be the one that does the most amount of hours. And so I think this worries a lot of people that they're not going to be able to meet this, but we have a great system where technically we're self-managing, but we're not mired in the day-to-day and a slave to our business on a day-to-day basis. We take all the components, all the aspects of our business, and we divide them amongst certain people. We have virtual assistants that work for us. We have lots of different cleaners, so we have redundancy in place. We have different handymen, and so we can kind of spread that out amongst other people who can help us with those tasks at a reasonable cost, so we can keep our cash flow really high. We can also exceed any one of their time, and we go over that 100 hours very easily on our short-term rental business. And it's not a super high threshold to meet. The great part about this is that you only have to meet the material participation threshold in the year where you're taking that tax write-off. For 2025, you could purchase a property still, meet the 100-hour criteria, and then in 2026, convert that property to a long-term rental or hire a short-term rental property manager. So it's just in the year that you're taking that benefit. And the other great thing is that this is between you and your spouse if you're filing jointly. So if you guys are working on this together, then you each need to get about 50 hours, and that time needs to exceed any one other person. Because if you're filing jointly, the IRS looks at you as one entity. So between the two of you, you've got to hit that threshold of material participation. So it's not too late to purchase a short-term rental at this stage in the year, because as I'm recording this, just about to go into September. Let's just say over the next several weeks, you started looking for a property, you got something under contract, then it was another 30 days to close. That puts you maybe toward the end of October, and you still have about 10 weeks left in the year. So if you divide that 100 hours amongst those 10 weeks, that's 10 hours a week that you need to spend on your short-term rental business. And that includes so many different activities. The IRS is actually pretty vague about what constitutes an hour. It can be a lot of things, from management to hiring cleaners to hiring a handyman to talking to your guests to setting up your listing to all these different activities that count. And so achieving that threshold of 100 hours and more than anyone else is pretty doable at this stage in the game. So now I'm going to walk you through an actual deal with real life numbers to show you the type of income tax savings that you could get if you were to do a similar type of deal to this one, in addition to all the other financial benefits that a great short-term rental brings. If this is helpful though, do me a favor and hit the like button. And also, if you want the name of a really great cost segregation company, that's the company that comes in and itemizes your whole property and lets you know what components you can write off against your active income taxes in year one, then go ahead and comment cost seg in the comments below, and I'll send you a training that this company that we use. It's an awesome company at a really affordable price. They've just put together this training that kind of walks you through how the cost seg system or the cost seg process works. All right, so now I'm going to walk you through an actual deal in real life numbers and the tax savings that this is actually going to provide. Because sometimes people describe this strategy and you kind of get a general idea, but I think it's super helpful to see an actual example. So this is an actual property that we purchased earlier this year that we're doing a cost seg study on right now. And so you can see these are 3 of the listings. So we bought this property. It's a 5-unit property in Valparaiso. And you can see these are the pictures of one of our units here. This is what the property looks like on the outside, but it's actually 5 individual units inside. And you can see these are 3 of the listings. There's actually 6 total listings because we have 5 units, but then we have the super listing where we list the entire building separate as one listing as well. And so this property has started to perform really well over the last couple months. But in addition, we're doing this cost segregation study that's going to give us this enormous tax write-off as well. All right, so these are the real world numbers that we are expecting on this property. So this is a 5-unit property that we bought in Valparaiso, Indiana earlier this year, and we're all into it for $675,000. So that's between the purchase price, the updates that we made to the property, and all the furnishing costs. So now you can't depreciate land, right? The IRS won't let you depreciate land. And so we're going to assume that about $75,000 of the value of this property is land. It sits on a pretty small lot, and most of the value is in the property itself. So that leaves us with about $600,000 of property value that we can depreciate over time. Now, we talked about only the components that wear out in 20 years or less can be depreciated in year one. And so that's approximately about 30%. And so if we multiply this by 30%, we're left with $180,000 that we can use then to basically, we're saying that this is a loss. It's a paper loss. So it cancels out $180,000 of our active income. So if you're working a W-2 job and you make $180,000 a year, guess what? Your tax liability just went to zero. You don't owe the IRS anything. So it can be super powerful. And so you can obviously look at your tax bracket that you're in, but let's just say you're in the 25% or you're paying about 25% because it's obviously a graduating tax bracket. This is going to save you $45,000 of actual money that instead of writing a check to the IRS or if you've been withholding this whole year so that the IRS can get paid at the end of the year, instead, the IRS is going to write you a check back for $45,000. So think about it. Instead of paying the IRS this money, instead you could own this high-performing short-term rental and stick $45,000 back in your pocket that you would have paid the IRS. That's a down payment on another property. That's basically buying a really nice brand new car if you want to. There's so many other better ways that you could spend that $45,000 than paying the IRS, and this is a very doable strategy. And one final point that I just want to share around this is that when most people implement this, they think about the traditional vacation rental, right? They go out and they buy that single family, high-end luxury vacation rental that's going to give them this big tax write-off. But the problem going forward then is that a lot of times it doesn't cash flow very much, or it has a negative cash flow. So now going forward, they have to feed this thing every single month. And instead, this is why we focus on this type of property. So these are the 6 listings that I talked about. So we have one for each of the 5 units, and then a super listing for the entire property if there's large groups that travel. And so this property, just in the first 2 months, so we listed it just before 4th of July. So we didn't even get all of July listed, and it was a brand new listing, so it wasn't optimized. But just in the first 2 months alone, owning this property that's, still relatively affordable for a 5-unit property, we made over $10,000 in July and over $16,000 in August. And August still isn't even over. We still haven't hit Labor Day when I'm recording this. So we've made over $26,000 just in the first 2 months on this property. In addition to getting this huge tax write-off, going forward, we've now got this asset that somebody else is paying off for us. Our guests are paying down our mortgage every month. It's cash flowing really, really well. It's appreciating over time, so it's going up in value as we get this write-off. And yes, there's this huge tax write-off in year 1, but we still get to write off the other 70% of the value of that property over the next many, many years. And so every year we're going to have a continual write-off into the future as well. Hopefully this helps clarify how this works for you and also inspires you to move forward with the short-term rental. I mean, if you're writing a check to the IRS at the end of the year, there is really no reason not to take advantage of this. You've already worked to earn that money that you're handing over to the IRS. So this just lets you keep that money that you've already worked to earn, and it's a great wealth accumulation vehicle for the long term. And if you don't want to do this alone and you want to work with me personally through the entire process of identifying the right market, the right type of property, the right type of financing, setting everything up so that your systems are all in place going forward, you can set up a call with me. We can talk through the Blueprint program, we can talk through your goals and see if it's a good fit for your situation. Thank you very much for taking time to view this video. I know there's a lot of videos on YouTube that you have the option of, and so it means a lot to me that you've sat through this entire video, and I hope it's been super beneficial for you. God bless, and I'll see you in the next video.
Okay.